Oh, good afternoon, everyone. Thanks for making it back from lunch. I'm David Brickell, Director of Institutional Sales at Paradigm. For those that don't know, Paradigm, we're an institutional liquidity network for trading block size and multi-leg crypto derivatives. I'm joined by an esteemed panel to discuss the institutional appetite for crypto and digital assets. It's been a dull couple of days in the world of institutional crypto. So it should be an interesting conversation and lots to unpack. So before we dig into things, do you guys perhaps want to introduce yourself, Andrei, a little bit about what you do?
Yeah, sure. I represent the traditional investment bank, Goldman Sachs. But over the last 2 years, we are developing a digital asset strategy within the bank. The team is growing, so we are now over 50 people. I represent the trading side of the endeavor. We are the first US bank to offer principal trading, principal market making to our clients in cash-settled crypto derivatives. But at the same time, we are exploring uses of blockchain in traditional financial industry, be it repo trades, be it bond issuance, and other ways that the blockchain technology can be used in the traditional financial sector.
I'm Boonen. I founded B2C2 a long time ago now, and I was actually in the same analyst class as Andrei. It was in FX options, and I was on the interest rates trading side. And I made the decision a little bit earlier to quit Goldman to start B2C2, which historically has been one of the main market makers in crypto, and today specifically is the main dealer on the OTC side, and it's now part of SBI, a Japanese bank.
I'm Jakob Palmstierna. I'm the CEO of GSR. We're a crypto market maker and systematic trader. We trade spot options, derivatives, and we also have a investment management arm.
Good stuff. And I guess just to set the scene a little bit, a good sort of starting point would be to look at where are we currently at in terms of the level of appetite, institutional appetite for crypto. How has that evolved over the last couple of years, perhaps, and how is it manifesting itself?
Well, I have to say that the situation of the last couple of years has evolved, especially in contrast to the last 2 days. So you have to recognize that. I find those seats extremely comfortable, actually. I imagine institutions today in crypto are a little bit less comfortable in comparison compared to what happened, but it's been a multi-year process that's going to continue. We went through many crises, Mongox, Bitfinex hacks, a bunch of stuff that we've always recovered, but it's just a fact of life that it's going to take them a really, really long time. And they're starting with cash-settled products, and one day Goldman's going to do physically delivered Bitcoin forwards and things like that. Probably, we have obviously been set back now a good 6 months, probably more with the recent events with FTX and Alameda, but it's not something that Andrei, myself, Jakob are going to let us, that's not going to stop us. We strongly believe in this market, and we're going to keep trucking, and the institutions are going to come when they come. In fact, one thing that people don't realize is that institutions have been active in crypto for a very long time, but it's institutions that needed to be in crypto. So it started with the retail brokers, IG Markets, eToro, etc. All those names were first in crypto. Of course, if you expected BlackRock to come in 2014, that was never going to happen. So you also have to let the market evolve in terms of products and the verticals that you have for all those traditional players to come in at the right time.
Our journey has been a little bit different. In a way, because we're a highly regulated institution, we are not active in spot, and so it was our decision to be active in cash-settled derivatives. And the way that it came about is client demand. So we have our existing clients wanted exposure to the crypto space. Initially, a lot of hedge funds, and we cater to a lot of hedge funds on the traditional trading side, they were attracted by the high levels of volatility, but also high levels of yield compared to traditional asset classes a few years back. What is changing now is that the counterparty risk is starting to be top of the mind for these traditional hedge funds as well. And so they want to see the names that they're already comfortable trading with to be the counterparty in crypto space as well. Additionally, look, we've got clients who are starting to have revenues in crypto, and they're looking to hedge their exposure. And so we are there to cater for their demand rather than trying to speculate in the market in any way.
And what on that, what types of clients and institutions are actually coming to you, and what are the kind of things that they're actually asking you for?
So it's all sorts of clients. So initially, the conversation over the last 2 years, it started with the hedge funds who were early in the game, and they wanted to have exposure to an asset that was rising very fast and exhibited a high level of volatility. And then obviously, given the news that it attracted, at the time, more traditional asset managers starting to inquiring about the space. And now conversations were firstly started with Bitcoin, then with Ethereum. It's still a slow-moving space for a lot of our clients. And there is a growing understanding that this is a space where they need to be active, they need to participate on behalf of the clients, and they're willing to see institutions such as ours to cater their demand. And then, of course, corporates, they're looking more corporates having public revenue streams within crypto from either NFT sales or direct investments in crypto attached companies. And so they look to hedge their revenues in a way that they hedge their revenues in FX, for instance.
Yeah, interesting. And how about yourself, Jakob? What are your thoughts?
Yeah, I think it's been alluded to here. We have quite a few of institutional players, whether they are market makers, sort of retail brokers or banks being active in the space. We have seen certainly hedge funds coming in and either trading directly or trading through their PB. The next step is the asset allocators. So you're looking at people like family offices, more traditional asset managers and pension funds and so on and so forth. There you have a hurdle in operational due diligence. They don't recognize how money is transferred within crypto or assets in transferred within crypto. The concept of wallets isn't included in their ODD, so that's a bit of a hurdle. So I think what we're seeing from that particular part of the allocators is probably people with a low friction investment committee, some family offices are being more active to deploy capital. And I think what's interesting in some of them have a very intrinsic view of crypto, as in they believe in certain areas of disruption and they want to have the exposure. Other people are looking at it purely from a portfolio allocation perspective. And they will say, so I have a new asset class which has a promising technology and a staggering talent density of STEM students moving into this industry with a huge amount of capital backing them. So that's interesting. And then if I look at the properties of how these assets are trading, I get a lot of bang for my buck because there's a lot of volatility, so I don't have to take a big position. And it tends to be, at least if you look over the last few years, it tends to improve your risk return. So we have seen those coming in at a small allocation. But what's interesting, I think, is that some of them are allocating without actually having an intrinsic view on crypto. It's just purely promising technology and talent density, plus the properties of crypto.
So it's fair to say that you feel in terms of the appetite, there's now...
I think it's lower today than it was 2 days ago.
Yeah, for sure. And it definitely, I think the events over the last couple of days, feel like a major setback. But we've been through events certainly over the summer, Bit Luna, 3 Arrows, Celsius. I mean, what was the response after those events, and what perhaps can we expect over the coming weeks in terms of how that's impacting appetite and the view?
Well, for our client base, which again is slightly different than from yours, it's actually, I would say, the response from that has been the opposite. So we are seeing more inbounds to trade with us, more because of the counterparty risk. But these are mainly, again, existing institutions that we have client lines in other asset classes that are coming back from DeFi protocols, from trading on unregulated exchanges, to try to face a different counterparty. In terms of products, what we've seen, and in terms of our client base, what they have been doing is effectively there are a few groups. One is hedge funds who start focusing either on the price movements, but also more so on the volatility or relative value volatility plays within the crypto market. The volatility space is still developing. The volumes are still growing there, so there's still a lot of opportunities that can be harvested in the space. And so definitely the hedge funds that are active in vol RV plays in other asset classes are coming to the crypto space, where a high level of volatility is actually a benefit. But also at the same time, we have a lot of cross-asset funds that are diversifying their exposure to crypto, because we had very high correlations between crypto and particularly the US equity market early in the year. And so it was part of the asset allocation to have again, as Jakob points out, a high return potentially within the same view of the market.
Well, I think there's indeed a dynamic at play where if you're a more serious player, like a Goldman Sachs, for reasons of counterparty risk, you get more inbound now. And that's also something, it's obviously a benefit to be owned by a bank at the BSVC2, because we also get some of that. But in reality, it's not just that. You find that in crypto, when there's a trauma like we just went through, people tend to, even though it's supposed to be trustless, tend to go towards institutions that they trust more. That's going to be a Coinbase, that's going to be a Kraken, rather than maybe smaller or offshore exchanges. But that only gets you so far to be Goldman Sachs. Because in reality, one of the big risks of crypto from a user perspective is not that Goldman's regulated or not regulated versus Binance, it's the crypto security. And when you look at, let's take maybe one of the exchanges that's viewed as the safest, Kraken, in terms of they've never been hacked, well, it's one of the least institutional exchanges. And so there's that extra dynamic of the security that just isn't really covered by whether you're a big financial institution or not. I'm pretty sure JP Morgan could also get hacked. And so that's one thing. Now, what we have in crypto here, and that's a lesson that we didn't have enough time from Luna and 3 Arrows it doesn't seep through, is that there is, by necessity, we have lots of credit links in the industry, and that's just how it's going to be for the rest of times, because financial markets always rely on credit. That's not going to change. Now, we have a lot of bilateral private credit links, and I think those links need to be made more visible. So you have protocols, interesting protocols like Maple, where you have pools that are completely public. You see exactly how much Alameda is borrowing. That's quite interesting. But I think we're going to need to have an actual credit market for crypto, because the fact that there's been apparently large loans made to Alameda, well, none of that's really known. And I think we need both visibility in terms of, well, who's actually borrowing in the market, but also tradability of that credit. And I think that's something that's going to emerge maybe in the next, call it 1 to 2 years of this debacle, is that we're going to end up, and I think that's a very good thing, with a crypto credit market, where you're going to have the big names, instead of relying on borrowing from Celsius and BlockFi and others. There's going to be an underwriting process. There's going to be something that's going to look and feel like a bond, but probably not going to be a bond from a legal perspective. And that's going to be traded either on exchange, OTC, on Uniswap. And I think it's going to be fascinating. And that's going to really help us give us price signals that we don't have today when it comes to the financial viability of all those big companies that we end up trusting. Why? Well, because Sam and CZ have big trader followings. That's a little bit silly when you think about it.
So it sounds very much like you're on the path of that, we need to go more DeFi. Because it's interesting to me that a lot of the institutions coming in, they're just more comfortable with like centralized exchanges. Saying that might have changed over the last day or two, but obviously one of the issues that we're seeing yet again this week is one of transparency. And as someone that was at Lehman's in 08, once that the lack of transparency, no one knew who owned what, and DeFi is obviously the potential answer to that. Now the regulator doesn't like it because I guess the on-ramps and off-ramps, how we control for that. But is that how you see the space evolving in terms of we need to go sort of more DeFi and perhaps less centralized? I
like that, but the problem you're always going to have is that you will not have every crypto firm's balance sheet in DeFi. So we're always going to have things like you have a long on DeFi that's going to be visible, but offset against a synthetic short OTC. That's always going to be the case. And so, to me, unless you've got the entire balance sheet fully transparent, it's as if you had nothing. So I think we're going to have to rely more on the market putting a price on the credit of those firms rather than just to have full visibility where everyone can make their decision. I think we're going to need to rely on credit asset managers doing the due diligence work, that some of it's going to be private with private financials, and then those signals seep through the market through prices.
I think CC promised us a Merkle tree of all the assets of Binance. That's great. That's good transparency for everyone to look into. But I think if you go back, when money was cheap, it wasn't accessible to crypto native players. So crypto natives started to lend to each other, well-funded firms that had raised external capital, build a big lending books. And this created a huge amount of sort of contagion within the space. And that was used for leverage, not only for DeFi, but also on-chain leverage. And we saw that on Tangle with Luna and Three Arrows. I think people were surprised about the level of contagion there was in the market. And it's the same thing here, right? It's exactly the same thing. And transparency, it's super opaque, and it's all comes in. But what I would say is that for traditional investors, if we're talking about traditional institutions, to understand what's happened here, you don't need to know crypto. This has nothing to do with crypto. This is just market contagion and leverage and a bit of greed. So transparency, I think, is going to be forced upon institution if they want to come in or if they want to trade with counterparts coming in.
Yeah, sure. Another area, again, I come to crypto from the sort of macro, and I think about crypto in a macro framework. Macro was boring for a long time, and we've now got a zero rate world, and we now that sort of positive interest rates, and we're seeing volatility in the macro space. How's that impacting the appetite for the move into digital assets now that macro's become a bit more interesting again? What are your thoughts around that?
Well, it has definitely changed the appetite to be more crypto because clients can execute larger volumes, also potentially larger leverage positions within the traditional asset classes, be it FX, be it equities, be it rates. If you zoom out of like the recent events, what's interesting to see, to your point, is that the volatility in all asset classes over the course of the year has increased in everywhere. Equities, FX rates, credit. In crypto, I'm talking more Bitcoin and Ethereum, it has actually dropped. The longer term volatility has actually been reduced over the course of the year. And we had a very interesting dynamic in September and October where the realized volatility of crypto was below traditional asset classes, which is not very common. But at the same time, we started seeing inbound clients asking whether we could have relative value plays based with crypto now, where we've seen more inbound saying, like, is this a good time to go long crypto vol by shorting other asset classes as well, for instance. But what's more is despite the traditional markets being very busy at the moment, every single big institution we speak to has still a dedicated crypto person on board. There are different stages of development, but there's a digital strategy for all of our clients. What's more, I would also say for our competitors, it's probably the digital assets team within investment banks are one of the few groups that are actually growing, and across numerous, whether it be European or US banks. And this is the value of not just trading or the volatility of the asset class, but it's more of the value for the blockchain technology to the financial industry as such.
And can you give us an idea in terms of, say, the appetite at Goldman Sachs and I guess at the banks? What's the appetite in terms of resources being committed to it? And also, what kind of timeframes when you're trying to strategize around that business in a very volatile sort of business? What kind of timeframes, what kind of resources are being put towards this?
Every bank has a digital asset strategy. So 2 years ago, we were around 5 people in the digital assets team. We've been grown to more than 50 and then another 20 engineers. And every other bank is on the similar scale of expansion, despite what is happening in the broader crypto community. And so the bank is allocating a lot of resources into not just trading or facilitating markets to our clients, but more importantly to the value of the blockchain technology that can change the way that the existing financial industry, existing operations are performed within the banks. And we're seeing collaboration within, within investment banks to drive the blockchain technology forward, to prove that the technology works and has increases beneficial improvements to the way that things are done today.
Well, markets businesses rely on volumes. That's the main source of revenue. It's completely correlated to volumes, whatever you do. And in crypto, volumes depend on price, sadly. I think we have to see what remains of our industry if we can't move beyond that dynamic where it's only rising prices that bring increase volumes by plateau from crisis to crisis. Now the problem is when it comes to prices, one of my favorite tweets a year and a half ago didn't get a lot of likes because I think maybe I'm a party pooper sometimes. It was rising interest rates are going to make Bitcoin very interesting, but not in the way that everyone wants. And I think that's what happened. High interest rates are going to make it so that's going to put a lid on prices for a while. I don't know why not everyone thinks that, but I look at the art market quite a bit, and it's quite obvious that when you've got assets that you can't really do much with, and they don't have a natural yield, their prices depend on the level of interest rates. I don't see why crypto would be any different, bar some utility that you can actually, yes, indeed derive, but the complex as a whole, right? And so we need to move beyond that, which is not necessarily going to be easy, but we have to come to terms with that. The macro environment is not going to be positive for quite some time now. But I do think, though, and I'm not one of those blockchain, not Bitcoin guys, but the high level of interest rates now in the real world makes it so that there's clearly a fixed income play within crypto. And we're starting to see some dynamics invert. You'll remember when you could just sell Deribit futures, buy physical, make 20% a year, we had a lot of institutional money come in to try to capture that. And now it's actually the opposite, because a lot of the crypto yield, well, most of crypto yields are just the demand for leverage, the demand to go long. And that's completely disappeared. That's why on Aave now you're lucky to get 1%, whereas you could get 10% just a few months ago. Well, you're seeing now flows in the other direction. There's a lot of captive money in crypto. A lot of people sitting on Tether and USDC. They don't know what to do with it because the yield is so low and they don't want to take the credit risk. And we're seeing now opposite flows where people are trying to bring in what they call real world assets, which is a bit of a misnomer in my view, RWAs, into crypto that are going to be financed with the captive wealth of crypto users. That's quite interesting that we're seeing both directions now.
I agree on that. When we're talking about yield, crypto had the most attractive yields if you take away credit risk, I mean, for as long as I've seen it, sometimes those were in the hundreds of percentage. Obviously, there was a huge amount of operational and credit risk attached to those, and protocol risks and so on and so forth. And I think that was one of the reasons why we didn't see the options market really take off in crypto, because inherently, I think as Andrei was saying, inherently if you hold digital assets, you hold a huge amount of vol, and vol is very valuable. But because there was so high yield in DeFi, people were sort of moving that way again. Now that yields have come down in DeFi and in crypto in general, I do think that we will see a growth finally in the options markets for crypto, both from within as well as from the clients and so on that Andrei is talking about. So that's a very needed and exciting development, because you can tailor your exposure quite handily with options.
Yeah, well, it's certainly an area at Paradigm that we're obviously hoping, given our sort of footprint in the space, and I mean, and to your point, I think one of the areas as well has been like access to liquidity, and which is another thing that hopefully we're trying to address in terms of providing that liquidity network that you can access that in that space. Just because we do want to go to some questions, because we thought, given what's going on, that there might be some questions out there. But just before we get to that, and just to kind of wrap up with this conversation, what are the key sort of couple of things that you guys are actually working on in terms of where your relative businesses are going forward?
Actually, at B2C to connectivity into real-world markets, because I personally lend to B2C to myself as an individual, and they're paying me, sub 3% rates. I'm not happy about that. I think it's just silly that we can't just pay a 20 bips commission to just get access to whatever short-term interest rates products exist in normal markets. And so that's something that we're working on, actually making sure that we ourselves have the lines, not just into the banks for FX swaps and things like that, which we have had for some time, but actually for money market products, which hasn't been necessary for the longest of times, because rates were zero. What are you going to do anyway? If anything, a lot of our Euro banks were charging us negative interest rates. That's the world has changed now.
Yeah.
I mean, we're very busy with sort of continuous improvement across the microstructure trading. We're a liquidity provider. I don't go into it here, but slightly different than in traditional finance. We work with a lot of the crypto issuers, and their network doesn't work unless there's liquidity. So that's something that we provide. And the market microstructure is ever evolving, and so we're spending a lot of time there. We're spending a lot of time on options market making. We've always been fairly big in that market, and we continue to be. So we're excited about it. Bespoke execution algorithms within crypto. I think it's we have a unique position of develop these, given the years of tick data that we've assumed, and for this panel, I think what's most interesting is that we are utilizing our the data that we have collected, and sort of we're a 280 people firm with somewhere around 100 engineers and the rest mostly quant, developing real systematic strategies, whether those are market neutral or directional in our asset management business.
The projects that we're working on are a bit different in a way. One is obviously in terms of crypto market making in our cash settled derivative products. I come from a background of FX options, and within FX options, the product scope that the clients are able to trade is just, I think it's bigger than anywhere else. You've got vanilla products, you've got barrier products, you've got digital payouts, you've got correlation products, you've got vol products as well. And in crypto, we're just at the very early stages of effectively of the market liquidity. What we expect and what we're waiting for is more participants, so there's more underlying hedging opportunities for the market makers to offer more complex products for variety of clients. But on top of that, within our digital assets team, we are really looking into how we can use it. So our main projects, how we can use it to improve efficiencies within the firm. So whether it be repo trading, whether it be digital bond issuance, just to say the few, but at the same time aligning our strategy, digital asset strategy, with strategic investments that we're making off the balance sheet, which is not common within the kind of a global markets division, where we're investing into companies that align with what we see we're going to be doing in the future as well.
Cool. So we've just got time to open it up to a couple of questions. Are there any questions at all for the panel that anyone would like to ask? It's hard to see. There's one at the back there. I can see a hand up in the white shirt here. Oh, there's a microphone. Let's wait.
Yeah, thanks, guys. There's a variety of an audience here from the traditional finance background, as well as some people who are more familiar with the DeFi background and Web3. And I think there's a common ground that we can find when it comes to regulations of the space. Now, there's a lot of people who are not, against the regulations, and there's a lot of people who think it is what is going to bring on the next wave of massive capital. How do you guys think that we find that balance to push the crypto industry forward without being too restrictive?
So on DeFi particularly, or generally in crypto? I'll answer it anyway.
Yeah, across the board.
So I think it's interesting in DeFi. I mean, we made a point earlier, which I think stands. So, what we try to get with regulation is fair and orderly markets and consumer protection. I don't think anyone argued that those things are very valuable, and those should be applied to any business, maybe even including transparency. But within DeFi, I think as Max mentioned, regulation won't protect the industry against hacking risk and security. Those actors will still prevail. So there's a big job being done in building that. Regulation shouldn't think that that's what they can fix. The other part is we're talking a lot about KYCing and showing making sure that we know who's trading where and so on and so forth. There is a bit of development in sort of zero knowledge proof, where in essence, if you can prove that you are the person trading the assets and you've been basically verifying yourself on the way in, we might not have to have this world where we have to show a passport to every single person that we meet on the street. So I think that for regulations, if we're talking about fair and orderly markets and consumer protection, I think certainly that would be great. And a global regulation, the more global it is, the more harmonized it is, the better, and the clearer it is, the better.
I'm going to say the quiet part out loud here. I think that many institutions do not think that regulation protects them in any way. And for them, it is a box-ticking exercise if they're going to trade with a regulated counterparty and nothing more. And I learned that the hard way early on. B2C2 was the first crypto company to get the MiFID investment firm license in Europe, and we thought it was going to be great. Then we onboarded one of the biggest brokers in the world, very well known, very large, and we said, okay, so we've got regulated entity, not regulated entity. Who do you want to face? The answer was, don't know, don't care. What they want to see is, do you have a lot of equity capital? Do you have, what are your security practices? Are you audited? That's the kind of stuff they want to see. And sure, regulators are forced you to have some processes around that, but you can also just implement those processes yourself if you actually want to get the clients. So I think that regulation for crypto is completely unfit for purpose. And I mean, in fact, FTX was supposed to be the regulated new poster child because they were going to Washington and actually using regulation as a competitive moat to elbow out Binance and other offshore exchanges. Well, guess who won in the end? And so I think that's a journey that many crypto companies have experienced. And in fact, it's been a little bit disheartening to see that some of the biggest firms have never paid anything more than lip service to regulation. So I don't think that it's actually that much of a drawback, in only maybe in as much as whoever signs the paperwork at whatever big asset manager needs to be able to cover their ass in terms of their career risk. I don't think it's really much more than that.
Well, I'll have to disagree, disagree with that.
Yes.
We are part of we are heavily regulated institution, and we respond to regulators not only in the US but in every single jurisdiction that we are present in, and we are present globally. And from the conversations with big asset allocators, what we're saying is regulatory clarity is important. In terms of how to structure the product offering to the clients. And at the moment, they're just trying to understand how they can work around that. And so regulation is exceptionally important into, I would say, the bigger, the larger institutional adoption. Not so much maybe for some hedge funds, or more crypto-native names.
But you use a very specific word, use the word work around that. And I think that's the point I was actually trying to make. A lot of institutions, they see regulation, they're looking for a way to work around that. Not necessarily because they think it brings an intrinsic benefit.
I have a hard time thinking about a crypto firm who doesn't welcome regulation, but they want clarity and they want consumer protection and fair and orderly markets. I think my point is that there's a lot more about security, about transparency that the market needs to deliver, and regulation is not the only answer. I mean, we were part of the first self-regulatory organization, ADAM, that was started in the US several years ago, and we were quite hopeful that regulation would come in. But on the other hand, let's say regulation historically for most banks haven't protected people. I mean, there's been instances where the consumers haven't been protected by the banks because the banks has been able to speculate within that regulation, and I think we see that in crypto as well. So I think there's a lot of work to do, but harmonized regulation across crypto where it's easy to understand the rules, perfect.
Yeah, I think as well an interesting thing from my point of view on that is that whilst the similarities between the world of crypto and sort of TradFi, there's also obviously clear differences, and it's about we welcome the regulation, we need the regulation, and certainly for the mass adoption that we were looking for. But you know, we can't shoehorn like the current sort of regulatory landscape into this completely new world. And I think my hope is that, you know, we'll see the regulators work with guys like here and the industry just to get a better understanding of exactly what the nuances are to this business, and bring a regulatory landscape that I guess is sort of more fit for purpose in that sense. And because, like you say, you know, we certainly for the more traditional institutional money and those big pools of capital that we want to bring into the space, that's exactly I guess what we need and what we're looking for. Ironically, before coming up here, we did sort of say between us we didn't really want to sort of talk about regulation, and then we've taken one sort of question and taken up sort of most of the time speaking about it. So we're pretty much out of time. So just for me to say thanks to you guys for an interesting panel. I hope you all found it insightful, and I think I'll sort of leave on just one thought. And when I think about the appetite for institutional and for digital assets, it reminds me of the Bill Gates sort of saying about, you know, most people overestimate where they'll be in 1 year from now, but underestimate where they'll be in 10. I kind of feel that's where we're at now in terms of, we all see the potential, we all get excited about where this space is going, how it's going to potentially transform all areas of business. But there's a lot of roadblocks, and we've seen that this week, and we've sort of taken a knock this week. And that's part of that's a feature of this exponential sort of tech. But I think the institutions are coming, the appetite's there, and who knows, in 10 years we'll be further than any of us think. So I'll leave us on that optimistic note, and thank you.
Thank you.